Welcome to the debate. In 1999, the Kargil War pushed India and Pakistan right to the brink.
Yeah, and the Indian stock market immediately panicked.
Exactly. I mean, it dropped 12% in a matter of weeks. But here's the wild part. By the end of that exact same year, the market was up a staggering 63%.
Which brings us to our focus today. We're examining a comprehensive 30-year data set of the Sensex
Right, spanning from 1997 all the way through 2025.
to basically answer a singular question about how markets process geopolitical trauma. Does historical market data prove that conflicts merely trigger, short-term psychological uncertainty?
Followed by predictable rapid recoveries.
Yeah.
Or does this generalized view obscure the severe structural economic damage inflicted by specific types of conflict?
Right.
I argue that the data conclusively demonstrates the former. Wars are fundamentally short-term psychological events for the market.
And I completely disagree.
Well, once the immediate fog of uncertainty clears, that clarity reliably triggers a mechanical influx of capital and, a subsequent rally.
And my position is that grouping all conflict-driven market drawdowns under this catch-all umbrella of uncertainty, it's a dangerous analytical blind spot.
A blind spot?
Absolutely. It flattens the historical record. I argue that averages and generalized recovery windows mask the profound structural economic damage inflicted by certain conflicts.
Okay, but treating every war?
Treating every war as a temporary psychological blip completely ignores the data points where conflicts shatter structural momentum, drain global liquidity, and cause multi-year economic stagnation.
Look, to understand why the market is inherently resilient to geopolitical shock, we have to look past the headlines. We have to examine the actual mechanics of capital flow over our 30-year data set.
Sure, let's look at the flow.
Between 1997 and 2025, the Sensex ended the year positive in approximately 75% of cases.
Right.
We're talking about 23 out of 30 years delivering positive returns, despite an almost constant rolling backdrop of global and regional instability.
But that's just an average.
Well, my core thesis is that the drawdowns we see during conflicts are almost exclusively driven by uncertainty, not permanent economic impairment. Think about the institutional algorithms and risk managers that control trillions in capital.
Okay, when the threat of war materializes, they de-risk.
Right. Their mandate is to automatically de-risk. They mechanically dump equities and park their capital in safe havens like gold or government bonds. It's a mathematical reflex.
But it's not just a reflex.
Wait, but the market is entirely forward-looking, right? It aggressively prices in the absolute worst-case scenario. So when that apocalyptic scenario fails to materialize, when the borders hold or the nuclear threat subsides, those same institutional investors are suddenly severely underallocated in equities.
Because they sold too much too fast.
Exactly. They are forced to rapidly unwind their hedges to avoid missing the upside. That sudden, massive unwinding of defensive positions is what causes the explosive relief rallies we see in the data.
That assumes the fundamental economy is fine, though?
Yeah, look at the extremes. After the initial 10 to 12% drop during Kargil, we saw that 63.8% end-of-year gain.
Yeah.
The 2003 Iraq War followed the exact same blueprint. A 10 to 15% drop in anticipation, followed by a massive rush of returning capital once the invasion began, ending the year up 72.9%.
Okay.
The mechanism here is entirely behavioral. The market doesn't hate war, it hates the unknown.
See, you're framing this entirely around the unwinding of institutional hedges, but that average recovery narrative completely ignores the fundamental economic reality on the ground.
How so?
Your baseline relies heavily on Kargil and Iraq, which introduces massive survivorship bias into your model.
I wouldn't say survivorship bias.
You are pointing to highly decisive conflicts where the core economic engine of the country wasn't severely impaired. Treating all war drops as a unified phenomenon of algorithmic uncertainty ignores the profound differences in how different conflicts strike the actual plumbing of an economy.
Okay, give me an example then.
Consider the data surrounding the Indochina War. The market impact was an estimated 15 to 20% drop, but the recovery wasn't a quick algorithmic snapback over a few months.
Well, no.
It was a slow, grueling 2 to 3 year process. Why? Because that wasn't just psychological uncertainty or risk managers temporarily parking cash in bonds. It was a revelation of actual defense unpreparedness.
Right, but that was a totally different era of...
The state had to execute a massive structural reallocation of resources away from infrastructure, away from corporate growth, and pour it directly into national defense. The economic ceiling was fundamentally lowered.
But that's localized to state planning.
Furthermore, trace the capital flight during global shocks, like the September 11 attacks in 2001. The Sensex fell about 13% initially, but it ended the year deeply in the red at negative 17.9%.
Yeah, 2001 was rough.
That wasn't just fear. That was a structural break in market momentum driven by sustained foreign institutional investor outflows.
FIIs, right?
Exactly. When FIIs, these massive global pension and mutual funds, pull their dollars out of emerging markets simultaneously, they drain the liquidity out of the entire system. Wars can, and absolutely do, break structural market momentum.
Okay, let's trace the capital exactly as you suggest. But I want to push back on how you are interpreting the clarity equals rally hypothesis, particularly regarding the Iraq War.
Go ahead.
In 2003, you had a scenario where the entire global market was just holding its breath. Supply chains were paralyzing themselves in anticipation. The Indian market dropped 10 to 15%.
Right, in anticipation.
But the exact moment troops crossed the border, the rally began. Why? Because a war in progress is a known variable.
A known variable?
Yes, corporations can immediately begin recalculating supply chains. Oil dependencies can be mathematically hedged. Risk models can be updated with hard data rather than speculation.
But
hold on, doesn't the fact that the Sensex recovered within months during both the Kargil conflict and the Iraq War prove that the initial sell-off was purely psychological fear? If the foundational economy were truly degrading, those rapid recalculations wouldn't result in a 70% rally. They'd result in a prolonged bear market.
you're assuming that once a war starts, it immediately becomes a clean, measurable variable. That is simply not true.
I mean, it's more measurable than a threat.
You are looking at Iraq and Kargil retrospectively. Decisiveness is a retrospective luxury. When you're in the middle of a conflict, you do not know if it will be a decisive victory that ends quickly, or a protracted multi-year grind.
That's fair, but the market prices in the probabilities.
Look at the broader data on the various Indo-Pak border tensions over the decades. Yes, one specific instance was decisive and saw a quick recovery because positive sentiment returned after a clear victory.
Exactly my point.
But another instance saw a 10 to 15% drop with only a moderate, sluggish recovery over a much longer period. Why? Because foreign capital simply stayed on the sidelines.
Well,
The institutions didn't unwind their hedges because the fundamental risk never cleared. When a war involves true economic shock, clarity does not magically create a rally. It simply clarifies the depth of the hole the economy has fallen into.
I think you're overstating the depth of that hole.
The market didn't stagnate after the Indo-China conflict because it was uncertain. It stagnated because the clarity revealed a vastly weakened economic posture.
Look, you're reaching quite far back to the Indo-China conflict, which took place in a completely different era of state-controlled economics and, frankly, closed financial markets.
It's still structural damage.
The modern, highly financialized era operates on an entirely different level of systemic resilience. Let's examine a much more recent example that directly bridges the gap between a localized conflict and global contagion.
Okay, which one?
The Russia-Ukraine war in 2022. This event was widely predicted to be the ultimate structural shock. It directly hit global energy supplies, sent crude oil prices surging, and triggered massive inflation fears across the globe.
It definitely triggered inflation.
The Sensex took an immediate 10 to 12% short-term hit. If your theory holds that conflicts directly affecting fundamental inputs like energy and inflation cause deep structural damage, we should have seen a multi-year bear market.
But we didn't.
Exactly. What actually happened mechanically? The system absorbed the shock, corporations passed the inflated costs on to consumers, energy markets rerouted supplies through alternative global channels, and the market repriced the risk.
So it just shrugged it off?
The Sensex ended 2022 up 4.4%. Let's be real. A localized conflict is essentially like a power outage in a massive manufacturing plant.
A power outage.
Yes. Production stops. It's dark, and the immediate reaction is panic. But the machinery itself is fundamentally intact. Once the breaker is flipped back on, usually within 1 to 6 months, the plant resumes its baseline output. Wars act as these power outages. They disrupt the market temporarily, but the underlying machinery of economic growth always reasserts itself.
A power outage implies the grid comes back online completely untouched. But what if the power surge fries the internal wiring of the factory?
Fries the wiring?
Yes, that is a much more accurate description of global contagion. When you point to the Russia-Ukraine war ending positive in 2022, you're pointing to an isolated data point that benefited from a massive, unprecedented post-COVID liquidity buffer.
I mean, liquidity is part of the system.
Central banks had just pumped trillions into the global system. That cash was still sloshing around, acting as a shock absorber. If you want to see how a localized event actually fries the wiring and cascades into a structural freeze, we have to return to 2001.
We're going back to 2001.
Geographically, the September 11 attacks were a localized event in the United States. But the contagion effect was instantaneous and deeply structural. As I noted, the year ended nearly 18% in the red.
But that was a unique geopolitical shock.
The mechanism there wasn't just a psychological repricing of risk. It was the plumbing of the global financial system seizing up. Panic triggered massive foreign institutional investor outflows from emerging markets like India.
Right. Outflows happen.
We need to be clear about what that actually does mechanically. When billions in foreign capital suddenly flee, the local currency depreciates. That makes importing essential goods, like oil, vastly more expensive.
Which causes inflation.
Inflation spikes. To protect the currency, the central bank is forced to raise interest rates. When borrowing costs skyrocket, corporate expansion halts entirely. You cannot neatly separate a war from an economic crisis because modern global conflicts directly trigger the exact inflation and liquidity drains that constitute an economic crisis.
See, I draw a very firm line there because you're conflating a standard market drawdown with a systemic collapse, and our 30-year data set explicitly separates the two.
I wouldn't call 18% a standard drawdown.
This is precisely why we have to look at the extremes in the data. The historical impact of a geopolitical event results in an average drawdown of 5 to 15%. In the grand scheme of equity markets, a 15% intra-year fall is the normal cost of doing business.
The normal cost?
It is. It happens in years with wars, and it happens in years without wars. It's simply the volatility premium investors pay to access compounding capital. The only events that cause true structural destruction, meaning the foundation of the factory actually cracks, are pure economic credit crises, not wars.
Okay, but
Look at the global financial crisis in 2008. The Sensex didn't fall 15%. It fell 52.4%.
right, that was massive.
That was a total structural liquidity collapse. The actual plundering failed. Banks refused to lend to other banks because the collateral itself was toxic. That required 2 to 4 years to recover from.
I agree. 2008 was worse, but
When you elevate a 10% war correction to the status of a structural economic shock, you fundamentally misrepresent the risk profile of geopolitical events. Wars simply do not have the mechanical power to destroy 50% of market value the way a true credit crisis does, because wars do not inherently destroy the collateral underpinning the global banking system.
I readily acknowledge that 2008 was the largest absolute crash in the data set. And yes, credit crises destroy capital in a uniquely toxic way. But we must reject this normalization of a 15 to 20% intra-year drawdown as just the normal cost of doing business.
Why? It happens all the time.
This is exactly where the academic uncertainty narrative fails the actual investor who is deploying capital. Let's look closely at the modern end of our data set. In 2025, we navigated a mild correction year of around 6.5%.
Very mild.
And then look at the highly volatile 2026 data. We saw a short-term fall of 3 to 5% in a single trading session due to localized border posturing, ultimately leading to a 10% correction from the peak.
Which is perfectly normal volatility.
You label a 5 to 15% war impact normal, but continuous capital destruction events in that range severely impair the compounding engine of any portfolio or corporate treasury. The math of compounding is unforgiving.
Well, sure, math is math.
If a market experiences a 15% drop due to a border conflict and supply chain inflation, it requires an 18% gain just to get back to par. If that drop is followed by a period of stagnation because foreign capital refuses to return, the loss of time value is immense.
But it always returns.
Dismissing these war-driven drops simply because they don't reach the apocalyptic 50% threshold of 2008 is a massive analytical oversight. A 15% drop driven by a state shifting capital to defense mobilization or factories halting production because they can't source raw materials is real, tangible economic damage.
It's a temporary pause.
It represents physical infrastructure not being built and thousands of hires being frozen. The fact that the stock market eventually recovers 2 years later doesn't mean the underlying structural damage to the macroeconomic trajectory didn't occur.
But the sheer speed of the recovery in the vast majority of these instances is the definitive proof that the structural damage was minimal.
I don't think speed proves minimal damage.
If physical infrastructure projects were permanently abandoned and hiring was permanently frozen in a way that truly damaged the macroeconomic trajectory, the stock market wouldn't and mathematically couldn't consistently recover within a 1 to 6 month window.
And yet, sometimes it doesn't.
But our 30-year data shows exactly that rapid cadence. 1999, 2003, 2020, 2022. Every single time there is a massive exogenous shock, the market compresses like a spring, algorithms absorb the new pricing reality, and the market rebounds.
You're grouping 2020 in there?
I am. The COVID-19 pandemic crash saw a brutal 38% drop in March. It was the ultimate unprecedented freeze of global supply chains and human movement. Yet the Sensex ended that very same year up 15.7%.
Oh, wow.
It was the fastest recovery from a massive drawdown in history. Why? Because the underlying corporate earnings power wasn't permanently destroyed. It was just paused. The exact same mechanical logic applies to geopolitical conflict. The market mechanism is incredibly efficient at aggressively pricing in the pause, but it is equally efficient at pricing in the resumption of normalcy.
Actually, pointing to 2020 completely proves my point about liquidity dictating recovery, rather than any inherent resilience to conflict.
How so?
The 2020 recovery was not a natural, organic market mechanism successfully pricing a return to normalcy. It was the direct result of the largest coordinated central bank liquidity injection in the history of human civilization.
Well, central banks are part of the market response.
The market rebounded because central banks literally printed trillions of dollars to artificially bridge an economic chasm that would have otherwise caused a global depression.
It worked, didn't it?
Yes, but when you look at geopolitical conflicts where that guaranteed central bank safety net does not exist, like the localized Indo-Pak tensions where foreign capital fled and local liquidity completely dried up, you do not see a magical algorithmic V-shaped recovery.
You still see a recovery.
You see moderate, sluggish recoveries that drag on for quarters or years. My fundamental concern with your thesis is that treating wars as temporary psychological blips breeds immense market complacency.
Complacency?
Yes. It assumes that because the Sensex has a 75% positive win ratio over 30 years, every geopolitical flare-up is just an automatic buying opportunity.
Historically, it has been.
But if a conflict actually severs a key commodity supply line or forces a developing nation to permanently shift 5% of its GDP from infrastructure development into military defense, the structural ceiling of that entire economy is permanently lowered.
I wouldn't say permanently.
The stock index might eventually grind its way to new nominal highs due to inflation, but the actual trajectory of real economic growth is permanently flattened.
We have to acknowledge that central banks reacting to stabilize markets during massive shocks is an inherent functional feature of the modern macroeconomic system, not some artificial anomaly to be discounted.
Fair enough. It's a feature now.
When we synthesize the totality of the historical record, the foundational thesis stands firm. The 30-year Sensex data is not a theoretical model. It is the empirical reality of how capital behaves under fire.
Under fire, sure.
While wars absolutely introduce vicious short-term volatility and aggressive algorithmic selling, the consistent 1 to 6 month recovery windows clearly demonstrate that market mechanics effectively process conflict as temporary uncertainty. We see typical mechanical falls of 5 to 15%, but the overarching result from 1997 through the recent 2025 and 2026 data is undeniable. 75% of those years delivered positive returns.
I can't argue with the 75% figure.
Exactly. Even in years marred by profound global anxiety and localized combat, the compounding nature of human enterprise, coupled with corporate adaptability, reliably overcomes the destructive impulses of geopolitical conflict. Capital always seeks a return, and once the worst-case scenario is invalidated, that capital floods back into the system.
And while I don't dispute that the long-term upward trajectory of the market is a testament to corporate adaptability, categorizing all conflict as mere algorithmic uncertainty drastically oversimplifies the true risks.
I think it clarifies them, actually.
Yes, 75% of years are positive, but that remaining 25% contains periods of brutal, structural wealth destruction that take years to repair.
Only in extreme credit events.
Or when wars expose fundamental economic unpreparedness, like the structural shifts following the Indochina War, or when they trigger cascading global panic and massive foreign liquidity drains like we saw in 2001. The shock goes far beyond psychology. It alters the fundamental plumbing of the economy. It raises borrowing costs, freezes expansion, and causes a structural fracture that takes years, not months, to unwind. Treating every conflict as a predictable temporary dip buys into a dangerous illusion about how fragile global supply chains and foreign capital flows truly are when placed under extreme geopolitical stress.
I think that's exactly where we find our most fascinating point of tension today. We both look at the exact same 30-year data set and agree on the sheer, undeniable long-term resilience of the market.
We do agree on the resilience, yes.
But the mechanics of how it survives, whether it's rapidly shaking off a psychological shadow as algorithms unwind their hedges, or slowly repairing a structural fracture caused by capital flight, is where the real analytical work lies.
Precisely. And that is exactly why examining the granular year-by-year data, focusing on the specific mechanisms of capital flow rather than just trusting the long-term average, is so vital for anyone trying to understand the reality of market cycles.
Absolutely. We might never have a perfect mathematical Richter scale for human conflict, and we may always be left staring at the horizon, wondering if the geopolitical storm is just a passing power outage or a fundamental crack in the foundation. Exploring these historical data sets provides the only true compass we have.